What if I told you the IRS just changed everything, and most seniors don't even know it yet? Starting in 2026, there's a major update to how Social Security benefits are taxed. And if you're retired or about to retire, this could literally put thousands of dollars back in your pocket every single year. Not a loophole, not a workaround, an actual rule change. And Washington doesn't want you to sit on this information. Here's what's happening. For decades, retirees have been quietly handing over a chunk of their Social Security check straight to the IRS. You worked your entire life, paid into the system, and then got taxed on the money you were supposed to receive. It never made sense, and finally, something is shifting. But here's the thing. This only helps you if you know how to apply it correctly. Getting it wrong could mean leaving real money on the table, or worse, triggering an audit. So before you file anything, before you talk to anyone, watch this entire video, because what I'm about to break down could completely change your retirement finances in 2026. Don't scroll past this. Your future self will thank you. Let's get into it right now. Let's start with something that might genuinely surprise you. The United States government has been taxing your Social Security benefits for over 4 decades. And for most of that time, retirees just accepted it as the way things work. You paid into the system your entire working life, sometimes for 30, 40, even 50 years. And then, when the checks finally started coming in, the IRS showed up and took a slice of that too. It felt wrong to a lot of people. And honestly, it was wrong. But now, in 2026, something significant is changing. And if you are a senior or a retiree, you need to understand exactly what this means for your financial life going forward. To really appreciate what is happening right now, you have to understand how we got here in the first place.
Back in 1983, Congress made a decision that would quietly affect retirees for generations. They decided that if your combined income, meaning your adjusted gross income, plus any non-taxable interest, plus half of your Social Security benefits, crossed a certain threshold, then a portion of your Social Security would become taxable. At the time, the thresholds were set at $25,000 for single filers and $32,000 for married couples filing jointly. In 1983, those numbers actually did exclude most retirees from paying taxes on their benefits. The lawmakers who designed the system genuinely believed they were protecting average working-class seniors. But here's the problem they either did not anticipate or chose to ignore. Those thresholds were never adjusted for inflation. Think about what that means in practical terms. In 1983, $25,000 was a solid income. It represented a comfortable lifestyle for a retired individual.
But inflation does not care about legislative intentions. Over the following decades, the cost of everything went up. Groceries, housing, healthcare, utilities, transportation. Meanwhile, Social Security benefits themselves increased through cost of living adjustments, which is exactly what they are supposed to do. But every time those benefits went up, more and more retirees found themselves crossing those same fixed thresholds from 1983. It was like a slow, silent tax increase that nobody voted for, and most people did not even notice until they were already caught in it. By the time we reached the 2020s, the majority of Social Security recipients were paying federal taxes on their benefits. Something that was originally designed to affect only higher-income retirees had crept down to impact people living on very modest fixed incomes. That is the broken system that 2026 is beginning to address. Now, here is where things get really important for you personally. The new rules being implemented in 2026 represent the most meaningful reform to Social Security taxation that we have seen in decades. What lawmakers and tax authorities are working to correct is the fundamental unfairness of those frozen thresholds. The core of the change involves significantly raising, and in many proposed implementations, eliminating the federal tax burden on Social Security income for seniors who fall within certain income ranges. The specific details vary depending on which provisions get fully enacted, but the direction is absolutely clear. The government is moving toward a system where average retirees, people who are not wealthy, people who depend on Social Security as a primary source of income, will no longer owe federal taxes on those benefits. This is not a minor adjustment. For millions of Americans, this represents a genuinely life-changing shift in their financial reality. Let's put some real numbers on this so you can feel the actual impact.
If you are a single retiree receiving around $20,000 a year in Social Security benefits, and under the old rules, you were paying federal income tax on a portion of that, the new rules could eliminate that tax liability entirely. That might mean an extra $1,000, $1,500, or even $2,000 staying in your pocket each year instead of going to Washington. For a married couple who together receive $35,000 or $40,000 annually in Social Security, the savings could be even more substantial. Now, I know some people hear numbers like that and think it does not sound like much in the grand scheme of things. But think about what that money actually means to someone living on a fixed income. That is prescription medications for the entire year. That is several months of utility bills. That is being able to visit your grandchildren without worrying about whether you can afford the gas or the plane ticket. That is the difference between living with financial anxiety and actually enjoying the retirement you worked so hard to build. One of the most important things to understand about these changes is that they are not automatic in the way you might hope. The government is not going to send you a check in the mail and say, "Here is your refund for all those years we overtaxed you." The benefits of the new rules flow through your tax filings, which means you need to be actively aware of what has changed, how it applies to your specific situation, and how to properly claim what you are entitled to. This is where a lot of seniors are going to fall through the cracks, and it genuinely worries me. People who do not know about the changes will continue filing their taxes the same way they always have, using old assumptions, old calculations, and old withholding instructions. And the IRS is not going to volunteer the information and hand it back to you. If you do not know to ask the right questions, you will not get the right answers. This is also the point where I want to be completely honest with you, because this topic is one where misinformation spreads quickly and causes real harm. Not every single penny of Social Security income is going to be completely untaxed for every single person under these new rules. The changes are income dependent, meaning the relief is targeted at seniors in lower and middle income ranges. If you have significant income from other sources, a large pension, substantial investment returns, rental income, part-time work earnings that push you into higher income territory, then you may still owe some taxes on a portion of your benefits. What is critically important is that you understand your own specific situation, rather than assuming you either qualify for full relief or that nothing has changed for you. Both of those assumptions could cost you money. Let's talk about what combined income actually means, because this is the calculation that determines where you stand. The IRS uses what is called provisional income to figure out how much of your Social Security is subject to tax. You take your adjusted gross income, which includes wages, pensions, dividends, capital gains, and business income. You add any tax-exempt interest income you received, such as from municipal bonds. And then you add half of your total Social Security benefits for the year. That final number is your provisional income, and it is that number, not your Social Security alone, that determines your tax exposure. Under the old structure, if your provisional income as a single filer was between $25,000 and $34,000, up to 50% of your benefits could be taxed. Above $34,000, up to 85% could be taxed. For married filers, the thresholds were $32,000 and $44,000. The new rules are raising and restructuring these thresholds in ways that will reduce or eliminate the tax exposure for a very large segment of retirees who currently fall in those ranges. Understanding your provisional income is also the key to doing some smart financial planning around these changes. Because here is something that surprises a lot of people. You may have some control over your provisional income, depending on how your assets are structured. For example, withdrawals from a traditional IRA count toward your adjusted gross income and push your provisional income up. But qualified withdrawals from a Roth IRA do not count as taxable income, so they do not affect your provisional income calculation the same way. If you are in a position where you are hovering near a threshold, where a relatively small difference in income could mean the difference between owing taxes on your Social Security or not, then the type of accounts you draw from and the timing of those withdrawals can actually matter quite a bit. This is the kind of nuanced, personalized planning that a good tax professional or financial advisor can help you navigate, and it is one of the main reasons why now is an excellent time to review your overall retirement income strategy. There is another dimension to this story that does not get talked about enough, and that is the emotional and psychological weight that tax anxiety places on retirees. I have spoken with so many seniors over the years who genuinely dread tax season. They worry that they are going to make a mistake. They worry that something changed and they missed it. They worry that they owe more than they realize, or that they have been under withholding all year and will face a surprise bill in April. That constant low-level stress is exhausting, and it is especially unfair when you are talking about people who have already done everything right, who worked hard, saved responsibly, and planned for their retirement. The promise of these new rules is not just about dollars and cents. It is about being able to open your tax documents without that sinking feeling in your stomach. It is about peace of mind, and that has real value too. Now let's address something that a lot of people are wondering. What about state taxes? This is a really important question because federal law and state law are completely separate systems. The changes we have been discussing relate to federal income tax on Social Security benefits. But many states have their own income taxes, and some of those states have historically also taxed Social Security income. The good news is that many states have already moved ahead of the federal government in providing relief here. In fact, the majority of states either do not have an income tax at all, or they fully exempt Social Security benefits from state taxation. A smaller number of states do still tax Social Security income to varying degrees, though many of those states have their own income thresholds and exemptions. The point is that you need to know the rules in your specific state, because your overall tax picture includes both federal and state obligations, and relief on one level does not automatically mean relief on the other. Let's also spend a moment talking about Social Security withholding, because this is an area where a lot of retirees have made a decision in the past that they may need to revisit. When you first signed up for Social Security, you had the option to elect voluntary tax withholding from your monthly benefit. The IRS form for this is called a W-4V, and it lets you choose to have 7%, 10%, 12%, or 22% of your monthly check withheld for federal taxes. A lot of people set this up years ago and have never looked at it since. If the new rules significantly reduce or eliminate your federal tax liability on Social Security, and you are still having money withheld every single month, you are essentially giving the government an interest-free loan for the whole year, and waiting until you file your taxes to get it back as a refund. That refund might feel nice when it arrives, but that money could have been in your account earning interest, or simply available to cover your monthly expenses. Reviewing and potentially adjusting your withholding election is a concrete, practical step you can take right now to benefit from the new rules immediately, rather than waiting for an annual refund. I also want to talk about a group of retirees who are in a particularly interesting position right now. People who are between the ages of 62 and 70 and still deciding when to claim Social Security. The age at which you claim has a dramatic impact on the monthly amount you receive for the rest of your life. Claiming at 62, the earliest possible age, results in permanently reduced benefits. Waiting until your full retirement age, which is currently 67 for most people, gives you your standard benefit amount. And waiting all the way until age 70 results in the maximum possible benefit, with credits that increase your check by 8% for every year you delay past full retirement age. Now layer the new tax rules on top of this decision. If lower-income retirees are going to face little or no tax on their Social Security, regardless of the amount, that somewhat changes the after-tax calculation of when to claim. The math still generally favors waiting if you are healthy and expect to live into your 80s or beyond. But understanding the tax implications of different benefit amounts is now more important than ever, as part of the overall claiming strategy conversation. Something else worth addressing is the relationship between Medicare and your Social Security income under the new rules. Your Medicare Part B premiums are determined by your income through a system called IRMA, the Income-Related Monthly Adjustment Amount. If your income exceeds certain thresholds, you pay higher Medicare premiums. Here is the connection. Because Medicare looks at your modified adjusted gross income, and because Social Security income factors into that calculation, changes in how your benefits are taxed can indirectly affect your Medicare premium calculations. This is yet another reason why these changes cannot be looked at in isolation. Your taxes, your Social Security income, your Medicare costs, and your overall retirement budget are all connected. And understanding how a change in one area ripples into the others is essential to making truly informed decisions. For those of you who are currently working with a financial advisor or a tax professional, I strongly encourage you to bring this topic up directly at your next meeting. Do not assume they have automatically incorporated the 2026 changes into the analysis they have done for you. Tax law is complex. It changes frequently. And even well-meaning professionals can be working from frameworks that have not yet been updated to reflect the newest rules. Come into that conversation prepared. Ask specifically about how the new Social Security taxation thresholds affect your provisional income calculation. Ask whether your current withholding elections still make sense. Ask whether there are any account restructuring strategies, like the Roth conversion conversation we touched on earlier, that might be worth considering in light of the new landscape. An advisor who cannot engage with those questions clearly and confidently is an advisor you might want to reconsider working with. For those of you who do not currently have a tax professional and have been handling your own returns, this is a year to seriously consider getting help. Not because the new rules are impossibly complicated, but because the stakes are high enough that missing something could mean paying thousands of dollars more in taxes than you legally owe. The cost of a qualified tax preparer who specializes in retirement income is almost always worth it when measured against the potential savings. If cost is a concern, look into programs like AARP's Tax Aid, which provides free tax preparation assistance to seniors from trained volunteers. These programs exist precisely because the tax system is complex, and retirees deserve access to accurate help without financial barriers. There is a larger political and social story here that I think is worth acknowledging as well. The push to reform Social Security taxation did not happen overnight, and it did not happen without a fight. Advocacy groups representing seniors and retirees have been pushing for these changes for years, arguing that the system as designed was fundamentally unjust to people living on fixed incomes. The fact that meaningful reform is finally arriving in 2026 is a testament to persistent advocacy, and it should also be a reminder that these kinds of policies are not permanent or inevitable. Tax law changes with administrations, with congressional priorities, and with shifting political winds. The relief being provided now is meaningful and real, but it is not guaranteed to remain unchanged forever. Staying informed, staying engaged in the political process, and understanding what is at stake for your financial security as a senior is not just good personal finance practice. It is a form of self-protection. As we bring all of this together, I want to leave you with the most important takeaway from everything we have covered today. The 2026 changes to Social Security taxation represent genuine, meaningful relief for millions of American retirees.
They are the result of a long overdue correction to a system that had quietly expanded beyond its original intent and was placing an unfair burden on seniors living on modest fixed incomes. The money that could stay in your pocket as a result of these changes is real money. Money that can improve your quality of life, reduce your financial stress, and give you more flexibility to actually enjoy the retirement you earned. But none of that relief reaches you automatically. It requires you to be informed, to understand your own income situation, to review your withholding elections, to ask the right questions, and to file your taxes correctly, using the rules as they now exist in 2026 and beyond. You worked too hard and waited too long to leave money on the table because you did not know these changes had happened. So share this with every retiree you know. Send it to your spouse, your siblings, your friends from work who are getting close to retirement age. Because this information has real financial value, and everyone in your circle deserves to have it. And if you want to go even deeper on how to maximize your Social Security benefits and protect your retirement income, stay right here on this channel. Because there is a lot more coming that you genuinely cannot afford to miss.